Hi everybody, welcome to another weekly update for the 14th of May. And periodically I just take a step back and have a look at the bigger picture, and that just helps me to set strategy and just get a sense of how things may unfold. And I've been paying particular attention to events over the last couple of weeks, and some things have become a lot clearer, particularly with respect to Europe, that really haven't been getting too much airplay, and they certainly could impact on things. So this week I want to cover things from a bit bigger perspective, and also to help us set our strategic direction a little bit more. So let's get into it. So first of all, just the important information. This is general advice only. It is not meant to be specific guidance for yourself in terms of trading. You need to consider your own circumstances and line this up against your trading plans. So the action for the week, overnight the S&P was down by about 0.8%, which represented around about 9 or 10 points. And that was after having been up at one stage. So markets really were all over the place over the last couple of days. Volatility is picking up in the US financial markets, in the equities markets, but it's still reasonably contained within its low range, and we'll have a look at the actual VIX index. The US dollar was higher over the week and is getting close to my short-term target, in fact very close to my short-term target. Now it's possible it could go straight through there, but it may also pause as well. Gold appears to me like it's put in a low price. Can't be sure of that, but I think it looks like it's bottomed. Silver, massive volatility. The raising of margins by the COMEX 4 times in 8 days, and then also by the Chinese in Shanghai for their precious metals market on Thursday, is really disturbing the silver market. So this is not a natural market. The patterns are not playing out according to normal trader psychology. But I also think that we're probably not too far away from a bottom in silver. And we did see very large commodity price volatility for the week, and that's the thing that's kind of got me thinking. It's the sort of volatility that is indicative of short-term tops. So I am being rather cautious, and I wouldn't be surprised to see a bit more of a pullback in commodity prices and stocks in the short term. So before we look at the actual charts, I just want to take a big picture look at what's going on. And while some of this material may not be what you focus on every day of the week, because it can be a bit overwhelming for some, this is really important. So I'd really encourage you to just try and digest a little bit of what I'm going to cover in the next few minutes, because this perspective is most important. So this is how I see the fundamental backdrop to world markets at the moment, but it's based on fundamentals. It's not what may happen in the short term. So I'm not making a prediction about how markets may react. All I'm doing here is noting and observing what the fundamentals are saying, and I think over time we're going to see this play out in some way, but in the short term, who knows. But it's really presented to help us with overall strategy and just setting our exposure levels at a sensible area. So short term, i.e. the next 6 weeks, it would appear that QE2, the quantitative easing in the US, is going to finish on June 30, and that means that US interest rates will almost certainly rise. Now again, this is based on fundamentals, not necessarily a prediction of how it will work, but interest rates should rise, and that should cause the US dollar to rise as well. Now the obvious consequence of that is that commodity prices then should fall, just inverse to the US dollar, and that also should make stock markets fall, because money will be coming out of the stock market and going into the US dollar as perceived a more attractive investment. How anyone could possibly perceive that is beyond me, but they will. And I think that will cause some panic exodus from markets and a lot of volatility, because we are still seeing high levels of leverage. We saw it in the silver market over the last 2 weeks when margin requirements were raised. It just caused futures traders to have to stampede out of there. So there is still a lot of exposure, a lot of leverage. So I think if this plays out the way that the fundamentals would dictate, we will see some more volatility and possibly some panic exodus of commodity markets and also stock markets. In the medium term, that is thinking up to December 2011, I believe, and I'm going to go into a little bit of this in the next couple of slides, I believe it is inevitable that the printing presses are going to have to be switched back on again, because the consequence of them turning them off will be too severe. So I expect that that process will all reverse itself. So stock markets will go back up again, commodity prices will go back up, and the US dollar will resume its downtrend. Long term, so beyond the end of this year, I'm expecting some periodic massive volatility from time to time, and I think eventually there's going to be another financial panic across all markets. Whether it's as bad as 2008 or worse or less, I don't know. And I think the time span that we're going to see that is probably sometime between 2012 and 2015. To me, the way things are going, it is inevitable that we are going to see far more volatility and another financial panic, because the fundamental situation that caused 2008 has not been changed, and that's basically too much debt and too much leverage, and that hasn't changed at all. So let's have a look at why I'm saying that. Well, there's two main things. One is very recent events in Europe, and recent in terms of even the last week or two. And secondly, the very unsustainable path that the US is on. And this is the bit that I think is just important to at least have a little bit of a working understanding of. So in Europe, there's been significant deterioration in recent months. If we look at the history of what's gone on here, Greece had to get bailed out, then Ireland, and now Portugal on the 4th of May agreed to a bailout. Now, Greece is coming back into the headlines in the last few days, and it would appear that the bailout they had is not enough, and so they're either going to have to be bailed out even more, or alternatively, Greece will have to leave the euro and go back to their own currency, and their currency will be massively downgraded, which will allow them to become competitive again. So I think one of those two things is going to happen. And either way, I think the euro is going to decline as a consequence of that. Now, that will mean, and also we've got Spain still at risk, and if anything happens there, then things will just get that much worse. Now, of course, the euro falling means that there's going to be some upward pressure on the US dollar. Now, looking at America. So there's certainly some issues in Europe. Looking at America, to me it's unsustainable. Just a few facts and figures. They owe $56 trillion in total debt for the government, corporate and private. That costs about $3.5 trillion a year in interest, which is about roughly the same size as the whole government budget. So you don't need to be terribly well versed in economics to appreciate that that's a pretty unsustainable situation. On top of that, they've got $100 trillion in future unfunded liabilities for pensions, for medical care, for all of the social programs that they run. 45% of all people in America receive some form of direct government payout. Just think about that. That's completely unsustainable. 130 million people pay zero tax. Government spending is accelerating at a rate that's just quite unbelievable. I had a whole lot of figures and charts, but I thought I won't bore you with all those. I'll just make the statement, and hopefully you'll accept that it is occurring. They've raised $600 billion in new debt since July last year, and that followed $1.75 trillion in the previous 12 months. So they're raising debt at a rate that's just unprecedented in history. So then that raises the question, what happens after June 30 when when QE2 officially finishes? That's if they don't do something about it in the meantime. So just looking at some of the very current signposts, the commodity price volatility for me is a signpost that we can't ignore. When you start to see commodity prices dive around up and down basically day by day in the kind of massive levels that they have, that's generally a sign of a top. So not at all surprised to see commodity prices decline from here for a bit. Now this has got nothing to do with the fundamental supply and demand situation that I've been talking about. This is short-term price action. The fundamental supply and demand situations have not changed one little bit. I'm just talking about the short-term paper commodity market, if you like. A second really significant sign is that PIMCO, which is the biggest bond manager, fund manager in the world by a long way, totally got out of US government bonds several months ago, and they are now short US government bonds. Now these are some of the smartest investors in the world. These guys really know what's going on, and they are betting big time on the US bond market falling over. And if that happens, then certainly stock markets will not react positively to that. Central banks are selling US dollars and buying gold. We've seen China doing deals with to buy iron ore from Brazil and give them their US dollars. So China's actively trying to get rid of the US dollars. We've seen Mexico as one example in the last few weeks buy 100 tons of gold. We're seeing that trend replicated all around the world. So there's some signposts that are indicating that some of the biggest players are certainly getting away from the US dollar, getting away from US debt, because they obviously see the potential for some very significant downside. The longer term outcomes, the US dollar will continue to decline. I think eventually it'll lose its reserve status, and gold and silver in that sort of environment really should explode. And all commodities will obviously rise against the US dollar until such point in time as it loses its reserve status, and then I have no idea what commodities might do. So that's some background to what I think is likely to unfold. So let's have a look at some charts. So first of all, here's the US dollar. On a daily basis, we'll pan back. You can see we've had a very big decline in recent months. This is the inevitable snapback rally that we get, and this is quite a bit about the euro falling as well, rather than necessarily strength in the US dollar. So this was a level that I'd drawn in on this chart about a week ago. For any of you that have been seeing these charts on a regular basis. So we basically got to that point last night and backed off it a little bit. It's not at all inconceivable this could end up higher. Let's have a look at the S&P index. That's it on a monthly chart. So you can see on a monthly chart, no real signs of anything dramatic happening in the US dollar, in the US stock market at this stage. Let's look at it on a daily basis. And we've certainly got a few lines here, but let me try to explain it. So these price retracement levels from the 18th of April to the peak that we saw on the 2nd of May, so that gives us three retracement levels: 1142, 1332 and 1324. Now markets declined to the 1332 level, which is the 50% level, and then bounced, and it went a little bit beyond. I thought 1344 would be as far as it would go. It actually went a bit further than that and reached a high of 1359, and that was when I said in the alerts that I was surprised at how short the consolidation period was, because it had gone beyond that level. But we're now back down, so we still are consolidating, so this is more what I expected to see. So take out this one-day blip last Tuesday, and this is very much the action that I expected. So 1324 is still possible, and I think that would be a reasonable point for us to look at positioning ourselves. Now, because of all of what I said before, it is possible we could see lower levels. So I'm only going to press the button here if I see some more positive action in financial markets. So that's where we're at with the S&P. I think another perhaps week or two of consolidation above 1324 would be normal, and we'll just have to keep an eye on these levels. A close below 1324 is significant. A close above 1360 is also significant. So there's some of the signposts that we're looking for. Let's have a look at gold. So gold, this is the path that I was expecting to trace out. Our retracement came back to this 1462 level, which was really a little bit below what I expected. I was expecting about 1473. We've then rebounded, so the path I was expecting, this is the A leg down, the B leg up, and then a C leg to maybe lower, maybe down here somewhere, or as may have happened, to a slightly higher low, and then we head off again. So we're still in this process of this playing out, but it's looking to me a bit like gold has bottomed. But again, we just need a bit more data to be certain about that. But I think in the medium term, certainly gold looking to go higher, just not quite sure of the entry point. Let's look at silver on a weekly chart, and you can see we've had this massive drop, and after such a massive drop, it's just not going to go straight back up again. It's just not going to happen that way. We've rebounded part of it. I said $39 to $40. It got to 39 on through the week, and we closed the week at 35. So silver will need more time. Let's look at our market, our index. So the ASX 200. Okay, so this is on a daily chart first of all. So we broke through the first and second retracement levels. We're looking to come down to 46.70. We actually hit a low of 46.75 on Friday, and then we bounced from there. That will probably get reversed on Monday, I suspect, with the US market down as it was, and it did go below 46.70 in the futures market. So the key now is to see whether this Australian market closes below 46.70 or 46.65. If it does, it's heading lower. Initially probably down under 4,500. And so I suspect we'll open down here on Monday, but it all depends on how it closes the day. So I'll be able to give you more information on Monday night. Let's just look at this on a weekly chart, just to put a different perspective on it. So on a weekly chart, you can see we've done essentially nothing in the Australian index since September of 2009. So the Australian index has net gone nowhere for about 18 months, as distinct from the US market. Let's look at the materials index. So on a daily basis, the materials index has retraced this run from the 15th of March up to the top. We've come down through this third level here, so the possibility is that we're still heading lower on the materials index. Let's have a look at this on a slightly bigger picture view. So bigger picture, we've got a level that we're sitting on right at the moment, which is 13,380, which is also these tops from here. So we're sitting very much on that at the moment. The bottom on Friday was 13,390, and we were looking for 13,381, so that's as good as. So the materials index has bounced off this first Fibonacci level, so a fall below there, which I suspect we will probably get on Monday, will see us now down challenging these other levels down at 12,863 or even 12,344. So again, Monday, the close on Monday will tell us a lot. And looking at the finance index, as we're aware, the finance index has done absolutely nothing for about 7 years. And you can see on a daily basis we still just continue to track sideways. We're in this broad trading range and we're sitting around about the middle of that trading range. So it's really hard to know. It's retraced. Let's tighten in here. The 50% retracement level. Let's just reset that. The 50% retracement level was 44.27. We dived below that but closed above it on Friday. I would expect we'll be down here challenging this level here. So again, the close on Monday is important. And let's look at energy. And the energy index also made a pretty good break of a trading range. It only lasted a couple of days and we're back into that trading range again. The energy index is certainly one of the stronger indexes in the medium term. It's been trending up quite well, but not looking all that flash in the short term, so wouldn't be surprised to see more downside, maybe down around this 15,200 level. I think eventually we'll see a move back higher, but at the moment I wouldn't bet on it. So there the one other one is the XSO, of course, the Small Ordinaries Index. And so panning back, Small Ordinaries Index had basically been in this large sideways move now since around about October of last year. So let's just tighten in and have a closer look there. So the 61.8% retracement level of this last run was 2,700. We've dipped under it 1, 2, 3, 4 times, and on Friday we did close below it at 26.92, off the lows though, so it's still not completely decisive, but I'm really thinking that this Small Ordinaries market is heading lower and probably down to at least this 25.60 area. So I think there's very, very significant reason to be very cautious about raising our exposure. So let's just have a look at the strategy that we really should adopt going forward. To me, it's all about managing the possible risks which may or may not materialize. Now, I've given you a lengthy rundown on how I see the big picture from a fundamental point of view. As you know, markets don't necessarily play out in that manner, so this may or may not happen, but I think there is enough evidence of risk there to be very cautious about what we do. The second thing you need to do is keep your thinking very flexible. Don't get in your mind that gold is going up or markets are going up or down, or don't just fix anything in your mind and start to block out other evidence to the contrary. I think keep your mind very open and thinking very flexible, and let's just go with what the charts are telling us. And at the moment, despite what I might think and what biases that I might have, I think there is sufficient risk in the market for us to take notice and have lower exposure to the long side. So certainly reduce trading exposure to the small cap resource stocks. Doesn't mean you can't trade them, it just means you should have less open and you should be getting in at lower levels. So definitely don't chase prices. We only want to be buying into spikes down, and also if you do get into them and you've got some good profit on the table, then be prepared to take that profit pretty readily. You should certainly have a balance of short positions in there. You need some ability to benefit from downside in the market. If you're not prepared to do that, then I would make sure that your exposure to the long side is very small, because I think we've definitely got some risks of more downside in the market. From my perspective at this stage, because I'm not sure, I'm assuming a trading range, and I'm going to trade stocks and indices and gold and silver. I'm going to trade them as a range. until the market proves otherwise. So in other words, what I'm doing is taking a middle of the road position to cover both eventualities. Now, all of these comments do not apply to longer term trades or investments. So if you're in the market for 6 months or longer, to me the fundamentals still look quite sound around most of the stocks that we're looking at, and so I would not necessarily be making any changes at this stage because those changes may not be warranted. But I think for traders who are looking at anywhere from the next few days to the next 3 months, I really think you need to be paying attention to what I've covered today. So that's it for this week. Longer than normal, but I just think it's a very important juncture, and markets are giving us signals that that maybe not necessarily all is well. So we need to do something about that. So please read the daily alerts in conjunction with this report. So that's it. Talk to you next week. Cheers.